Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Wednesday guest and friend of the channel, Anna Kelly. Hi, Anna.
Hi, Michael.
So I've been wanting to ask you this question because you and I have experienced a lot of the same things, right? The dot-com crash, real great recession. So we've had similar investing careers.
Yes.
So what I wanted to ask you is, what do you think happens to residential real estate? Residential. So just 1 through 4s. We'll forget commercial for this discussion. 1 through 4s. If the stock market crashes 50%, Dow, S&P, NASDAQ, Russell 2000, everybody, all of them are down 50%. Let's say it happens within a 6, 9, 12-month span. Do you think a 50% stock market crash bleeds over to residential real estate and thus it has to fall 50%? What do you think?
No way. Real estate is a preservation of capital play.
Yeah.
Real estate really gives investors everything they're looking for, right? So when I started out in private banking and Bank of America back in the late 90s, we were trained 3 things that really stuck with me. A lot of that training never really helped me, and it helped me learn what not to do, right, in reality. But the thing that really stuck with me that helps me as an investor today significantly is that every investor through the continuum of our lifetime is looking for 3 things. It's simple: cash flow / income, growth / appreciation, and preservation of capital. Usually when we're young, our income needs are taken care of by a job. So we can take a lot of risk for things that can grow, that have risk associated with that growth. And if we lose a little and make a little and lose a little over many, many years, 4 decades, till we're 65, we can take more risk in the things that we hope are going to grow our wealth. And then once we retire, we need some of those things to create income again. And we want to be really low risk and preserve everything we've worked so hard for. So when you think about real estate has all 3 of those things built in, whether it's residential, whether it's commercial. Real estate in general, even with the corrections and the crashes regionally, a few times a generation, in general goes up 4% per year. And that's a number that you can pretty well say it's gonna keep going up. So there's that growth piece, and you can force the appreciation, you can force growth much higher, and you have periods of much higher growth. They rarely lose money. So that's asset preservation. You've got mortgage pay down, so that's increasing your net worth and your growth. And you have cash flow on most real estate if you do it well, right? So basically, when a stock market is crashing, all of those investors in the stock market are still looking for one of those 3 things. They either want income, they're buying things that are paying dividends. They want growth, they want things that are going to go up. And when things are coming down, their number 1 financial goal is rocked, right? Quickly, they say, we are scared. We need to run to something that's going to give us safety. And so they leave the stock market. Well, what are their choices for safety, Michael? Right now, a 10-year CD is paying 2%. A 10-year treasury note, I apologize. A 5-year CD, I looked it up yesterday, is paying 1.5%. When inflation's 7.5%, do you think you want to park your money at 1.5 for 5 years or 2 for 10? No, because you're still losing money. So that growth goal is gone. Preservation of capital is gone. So you can invest in gold and silver, right? Those things tend to hedge inflation well, hedge in a recession, but they don't really, it's still kind of like the stock market in that it goes up and down and up and down. So it's more of a preservation play than it is like a real growth play. So what are you left with? And this is what people don't understand when they say real estate's going to crash 30%, right? They go to real estate and they go to apartments first, Class A, big apartment buildings, nothing's going to go wrong. And they will pay cash. They'll take all their money, pay cash for a huge apartment building, which is why cap rates are low, prices are super high, because there's lots of institutions who are buying them up and have been over the last 2 years thinking, this isn't going to last, right?
Yep.
So it's a preservation of capital play. But what a lot of people don't realize is a lot of these big REITs and hedge funds, they've been buying up single family residential homes like in mass over the last couple of years. And they did it in 08 and 09 too. So after the crash of real estate, real crash that was driven by real estate related stuff, hedge funds came in. BlackRock bought a ton of single family homes.
Yeah.
So they're doing it again, right? So I have confidence in general, when we do a broad swath of the US, that housing supply is already low. People are saying, I'm not moving now because rates are going up. The demand's going to come down because supply is really low, right?
Exactly. Yep.
Now you've got all these other buyers coming in, these institutional buyers that went out of the stock market. You're going to have really high demand, and you're going to keep really low supply for a while until real estate prices keep coming up to the point that it equalizes.
Yeah.
So I do not believe that real estate is going to come down this year, next year, generally speaking, with everything else going on. If you had asked me a few weeks ago, we may have talked about this a few weeks ago, if the stock market remains stable, if Russia wasn't invading, Ukraine, and interest rates went up a lot, I would expect that the level of growth that we've seen over the last 2 years is going to slow.
Sure.
2022 is still higher prices. 2023 maybe starts to equalize, but I don't see a scenario unless you're in states and big cities that people are fleeing from for other reasons.
Exactly.
Those areas, I think, have a real problem. The Southeast, the Southwest, you're not going to see a real estate crash. I'd bet money on it. In fact, I'm now moving a lot of my money to Florida, to Tennessee, to Texas, and I'm looking in the Carolinas, and I have been for a while, but cash flow is hard there, and it will be for a while, right? Yeah. But I think a stock market crash is actually really good for continued appreciation of real estate. So if you own real estate, I wouldn't be real worried. If you're trying to buy more, prices are going to be high. It's a time that we're just not going to get as great of a deal with higher interest rates and higher prices, but I'm still buying.
Yeah. Yeah. When I think about a 50% stock market crash, I've seen them a couple of times. So, and I think you've nailed them all, but I'll kind of give you my words on them. First and foremost, there will be a couple of markets. I happen to live in one, the Silicon Valley, that you will see transactions stop, and you may see some adjustments in prices. Because again, a lot of people that buy in the Valley today are using stock market money to be the down payment. When that disappears or gets cut in half, or you just want to keep the RSUs because it'll come back, whatever, you could see transactions stop in the Valley. And ultimately the people that have to sell, or if you've owned it for 20 years, you'll take a 100K pay cut because who really cares? So there will be some markets, pretty small, like the Silicon Valley, maybe like LA, maybe like New York City, where wealth or stock market wealth was the feeder for down payments. So that will definitely happen. But when you think about the investors, this is what pushed me to real estate after being very successful and then not successful in the stock market, is like, I want something that's tangible, that's real, that I understand. And not only will you have guys like me or ladies like you come in, but then you have Wall Street going, hey, the best risk-adjusted return is 6% single family. Give me some more. They're even going direct to builders and buying entire communities.
Yes,
right?
They are. Build to rent.
Yeah, exactly. This is changing. And oh, by the way, the one thing that you didn't mention, but I know you know about, is foreign buyers. We've essentially been locked down for 2 years as a worldwide economy. That will open up, and all these foreign buyers that are nervous about what's going on in Europe or South America with crazy inflation, or Asia, they're going to come back and start buying, and they're going to buy the Class A stuff, right? They're not looking for, mom and pop one rental at a time. They're like, no, I'm going to go buy that penthouse in Miami or wherever. So
such a good point. I didn't think about that off the top of my head. I mean, now that you say it, it's like, no brainer, right? But there has been a reduction in foreign buyers over the last couple of years because they can't get here, right?
Yeah, they can't get here.
But yes, I mean, the U.S. economy is still doing better than most countries around the world right now and providing better returns. So that's a really good point.
Yeah. So a 50% stock market crash, if it occurred in 6 or 9 months, it'll impact a couple of markets. Again, the Silicon Valley, I think, is most obvious. But overall, national average, and again, let's think about what a 50% stock market crash is. If that happens, we are probably in a recession. We probably have unemployment go from 4 to 6, or heaven forbid, 8%. right? So it's a bad time. Stagflation might be the best answer versus a deep, dark recession.
Right.
I still think real estate does okay. And oh, by the way, the Fed is out there. The Fed takes rates, the Fed funds to 2.5. They have ammunition. They'll lower them back down, and the party continues. So it's interesting.
Two really good points there. We get real worried about interest rates going way up, but the Fed raises interest rates, and back in the 70s, I think they raised them to like 20%. It was really, really high. But as soon as that kind of cools things down, you always head into a recession. I don't know any time that you don't head into a recession historically.
Yep.
And as soon as that happens, again, back to the point about GDP, which I think we talked about in the first episode, the Fed needs that production to start back up for the US economy to come back. The only way they do that in a recession is they start lending money cheaply and encouraging companies to continue to borrow. So those rates come back down, so I'm locking in some rates that are 5 years, and people are going, I can't believe you're locking in, because after 5 years, they could be crazy. Usually these mass inflation cycles last a couple of years, then you go into recession for a couple of years, and then you start to kind of stabilize and rates stay low. So I'm not super, super worried about that. But the other point that I think is real important, because we talk a lot about real estate, and I always keep coming back to, and I know you agree with this 100%, it's very regionalized.
Yes.
It's also very specific to certain market classes. So to your point about foreign investors wanting to come in and buy the A-class stuff, and these big REITs wanting new build homes, new apartment buildings.
Yes.
They want that because it minimizes the risk that, number one, that things go wrong with mechanicals and real expensive repairs derail that 3 or 4% that they're getting on their money. But number two, because they know that when a recession happens and when layoffs start to happen, there's two groups that get hit the hardest. It's the average income household, what we call C-class renters, and obviously D, the poor, they're hit hardest. The D residents usually have Section 8 housing, and so your income doesn't go down terribly, but there's a lot of risk for that, right? But high-paying executives who happen to rent, most high-paying executives own, right?
Exactly.
But those that make more, that rent A-class apartment buildings, you will see some people move down to B apartments in an A area, right? They still want to be in the same nice area that has all the same amenities and all the things they do every day. But when we have unemployment, the most recession resilient historically, and I've studied this a lot, it's why I'm almost completely in class A to B area neighborhoods that have a strong hospital system. Actually, the number one marker for recession resilience of any town is having a large hospital system that's a research hospital. It's the number one market in all recessions that show and predict whether housing, single family apartments will actually do well in a recession. The number two is the number and diversity of jobs, employers, right?
Definitely.
So if you're worried about recession, and I am, I'm making some changes. I'm diversifying even more now that we're heading where I believe we're heading. I want to own residential and commercial buildings that are in class A to B areas, where even if people are hit hard, they usually have savings. They will usually be faithful to pay rent because they do not want their credit report hit. They don't want to leave the area with all the amenities. And you have to have strong schools and low crime. So if you have a hospital system, if you have really diverse, a lot of employers, so that even if each one lays off 10%, you've still got a lot of industry, or one industry crashes, God forbid, an oil company goes down, right? All these other companies are still employing people. That's going to give you the best recession resilience. So I want to be, as an investor, not just invested in real estate. I want to be smart enough to know, why do the big REITs and hedge funds and foreign investors buy class A areas? Because they know that they're recession resilient. It'll preserve their capital. If you're investing in lower end neighborhoods that don't have those recession resilient qualities, you could be hurting a little bit as well if the recession goes deep, because the poorer people are hit the hardest. So just something to think about that I think is a really important distinction. If you're able to sell high in a class D, C minus, even C neighborhood, sell high, move some of that money into class A to B neighborhoods,
Mhm.
your cash flow might be a little less, but you reduce your cash flow priority and you increase your preservation priority when you're in times like this. And then when things stabilize, you can sell them and you can go back to some of your higher cash flowing deals. That would be my recommendation.
Folks, if you watch stuff like this, you need to follow Anna Kelly. Anna, where would you like them to follow you?
Great. You can follow me on reimom.com, on social media, Anna Kelly, REI Mom. And if you are a passive investor, if you're accredited and you want to invest in apartment community syndications that make an impact on the community, you can follow me at greaterpurposecapital.com.
Thanks, Anna.
Thanks, Michael.